After studying this module, you shall be able to learn and understand the concept of financial market, identify the role and importance of financial market, understand the various types of financial markets, and analyze classification of financial markets and their efficiency on financial system. A financial market is a market in which individuals and companies can have trading for financial securities at low transaction costs and at prices that reflect supply and demand. Broadly described as any marketplace where sellers and buyers participate in the trade of assets and as equities, bonds, currencies and derivatives. Financial markets are known to have transparent pricing, fundamental regulations on trading activities, cost and fee, and market forces play their role in price determination while trading. Financial markets deal in financial instruments, and these instruments differ in their characteristics such as liquidity, risk, maturity, tax status, rate of return and so on. The price in the financial markets is known as the rate of interest. Under the conditions of perfect competition, the expected demand for money is equal to the expected supply of money, and equilibrium price for funds, that is interest rate, is determined. Allocation of financial resources to its various uses takes place in the financial market as there is discrepancy between the demand for money and supply for money. This discrepancy arises due to the intervention by the authorities to control the price of money. That is, interest rates are administered due to which demand for funds is not equal to supply of funds. Thus, the functions of a financial system are to establish a bridge between surplus spending units and deficient spending units, and thereby encourage savings and investments, and to allocate financial resources efficiently to accelerate the growth of economic development. Let us now discuss the importance and role of financial markets. Efficient and well-developed financial markets provide the following benefits to the economy. A. Financial markets bring together the surplus spending units and deficit spending units. B. Financial markets improve allocative efficiency of financial intermediaries. C. Efficient market improves interest rate signals in the economy by making monetary policy effective. D. It helps in deeper integration of domestic financial markets and international financial markets. E. It helps in absorbing shocks from external environment and makes the internal market less volatile to international turbulences. F. Well integrated financial markets help in sustaining high growth and ensure financial stability. G. Strong financial markets help in accumulation of physical and human capital and helps in faster technological progress. Thus, a well-developed financial market is an absolute must for the growth of the economy and for the integration of domestic market and international market. Let us now know the kinds of financial markets and their efficiency. Financial markets are of various dimensions, namely 1. The money market, 2. The government securities market, 3. The capital market, 4. The corporate debt market, and 5. The foreign exchange market. The main focus of this part of the module is on various parts of the financial market and various concepts of efficiency in those markets. The term efficiency refers to a concept where there is an efficient allocation of various resources and the wastage is at its minimum. Thus, where there is most productive use of the resource with minimum cost and maximum advantage, we say efficiency prevails. Efficiency can be judged by using the following 5 concepts. Number 1, the information arbitrage efficiency. Number 2, the fundamental valuation efficiency. Number 3, the full insurance efficiency. Number 4, the functional or operational efficiency. And lastly 5, the allocational efficiency. All the above concepts of efficiency are applicable to all the types of financial markets to determine the level of development of that segment of the financial market. Let us start with each type of financial market and judge its efficiency on the parameters given above. We shall now discuss the money market or call money market. This is a short-term market for trading of surplus funds, usually of banks, for a period ranging from 1 day to a fortnight. Since the maturity period of funds is very less, the money in this market is considered to be highly liquid and borrower or lender may demand it at any time. This market helps banks in maintaining a balance between liquidity of their funds and profitability from short-term lending of funds. While adhering to the guidelines of the Reserve Bank of India, which governs their financial activities, call money markets are mainly located in the big industrial states like Mumbai, Delhi, Kolkata, Chennai and Ahmedabad. Participants in the call money market are scheduled commercial banks, non-scheduled commercial banks, foreign banks, state district, urban and cooperative banks, discount and financial house of India and Securities Trading Corporation of India. Efficiency in the call money market can be judged by using the following criteria. Number 1, information arbitrage efficiency. This concept refers to the gain from information arbitrage. In other words, if information available to the money market participants is not equal, the participant having more information then the other would gain more. Thus, we say that markets are inefficient, but if there is a perfect competition, there would be no such gain to any participant. In India, call money rates are freely determined by market forces and informational asymmetry is also present in the market. 2. Fundamental valuation efficiency. When the markets are perfectly competitive, fundamental valuation efficiency takes place. This concept of efficiency equates the present value of discounted future income streams with the cost of investment of that asset. 3. Full insurance efficiency. Market efficiency through this concept refers to the presence of avenues to mitigate risk or hedge risk. The higher the avenues present to reduce risks and future contingencies, the greater is the full insurance efficiency. As call money market is supervised by the Reserve Bank of India, risk mitigation is an integral part of this market. 4. Functional or operational efficiency. A market is considered to be operationally efficient where the cost of providing funds from lenders to the borrowers is minimum and there are reasonable gains for the intermediaries also for facilitating such money transfer. 5. Allocational efficiency. Money mobilized has various alternative investment avenues. When investment takes place in the most profitable avenue, after comparing the marginal efficiency of capital in various other alternatives, allocational efficiency is said to be present. Thus, if a financial market is efficient in terms of the above parameters, it is considered to be a well integrated, efficient and sound market. Let us now understand the government securities market. The term government securities refers to the securities created and issued by central government or state government for the purpose of raising a public loan. The government securities market deals with tradable debt instrument issued by government to meet its funds requirements. In the primary market, government securities issue helps government in raising funds in the secondary market. The securities help in regulating and influencing money policies through open market operations. Let us now know the concept of efficiency as applicable to the government securities market. Number 1. Information arbitrage efficiency. According to this concept, efficiency market refers to a market where there is no information arbitrage and dissemination of information takes place. In the government securities market, there are no gains to any market participant as complete information dissemination is there and market is considered to be efficient. 2. Fundamental valuation efficiency. In this market, the market price of government security is equal to the intrinsic value of the security and therefore the market is considered to be efficient. The market helps in better price discovery to the Reserve Bank of India. 3. Full insurance efficiency. The extent to which risk mitigation is possible indicates the efficiency of a market. In case of a government securities market, since securities are issued by government itself, there is no risk and market is considered to be efficient on this front also. The market also facilitates the introduction and pricing of hedging products. 4. Functional or operational efficiency. A deep and liquid government securities market facilitates borrowings from the market at reasonable cost and provides an effective transmission mechanism for monetary policy. 5. Allocational efficiency. Market for government securities provides funds to the government which are mainly invested in infrastructure projects where the benefit to the economy is maximum. Thus, as far as resource allocation goes, this market is highly efficient. We shall now throw some light on capital market. Capital market in a broader sense refers to the various ways or channels which are used to make available financial resources from the investing class to the entrepreneurial class. It provides a mechanism for reallocation of resources from those who have surplus money to those who need money for business purposes. Thus, it can be said that capital market is the main supplier and facilitator for capital formation and helps in economic development. Let us move on and discuss functions performed by capital market. 1. savings mobilizer for economic development. 2. It pulls foreign capital along with the skills to maintain required rate of return. 3. It helps in productive utilization of resources. 4. It helps in balanced and diversified industrialization through making the resources available for all. 5. It enhances the efficiency of financial system. 6. It makes firms disciplined to perform and deliver positive results. 7. And lastly, it enlarges the financial sector and helps in the financial deepening of the economy. We shall now focus on the concept of efficiency as applicable to the capital market. Efficiency concept as applicable to the capital market refers to the efficiency with which the main function of resource allocation is carried on in the capital market. In other words, market is said to be efficient if productivity of the capital is enhanced and there is no wastage in the use of resources. Let us discuss each and every aspect of efficiency regarding capital market. A. Information arbitrage efficiency is generally present if the markets are perfectly competitive, which is not the case for Indian capital market. There is no equal dissemination of information and the informational asymmetry is present. Therefore, the market is not said to be efficient. B. Fundamental valuation efficiency requires market price of a security to be equal to its intrinsic value. Such efficiency is also not present in the capital market because stock prices are not based on companies' fundamentals. Thus, we can conclude that this type of efficiency is also not present in the Indian capital market. C. Full insurance efficiency is present in the market since there are various financial instruments through which risk diversification and risk minimization is possible. D. Functional or operational efficiency is present in the Indian capital market. This cost of transmission of resources is less than the procedure are also hassle free. Sale and purchase of financial instruments is now much smoother. Let us now study about the corporate debt market. With the ever increasing needs of the funds of the growing Indian economy, corporate debt market has started emerging as a market for providing long-term funds to the industries where gestation period is long. In the industrialized nations, debt market provides an impetus for growth than the equity market, while in India, debt market has started picking up and providing funds for infrastructural projects of many sectors of the economy. Role of corporate debt market in the economic development. A. It finances massive long-term investment of various sectors such as power, telecom, ports and housing. B. Its cost of financing is also less vis-a-vis the cost of bank deposits and equity. C. For long-term investment, this is a source other than bank financing such investment. D. It nurtures credit culture and the market discipline. E. When stock markets show fluctuations and become volatile, this becomes a good option. F. Credit risk pricing becomes more efficient with the presence of a sound debt market. Let us now understand the concept of efficiency in the corporate debt market, which can be judged as follows. There is a low transparency in this market. Pricing of spread against the benchmark is missing. The market generates a flat yield curve. All the above reasons result into low efficient market. Buyers also lack interest in the market, and therefore this market has not made any significant impact on Indian financial system. It can be said that various criteria used to judge efficiency of corporate debt market shows inefficiency in the market due to the inadequate presence of this market in the financial system. Let us now understand about foreign exchange market. The Indian foreign exchange market has three levels: A, the Reserve Bank of India; B, the authorized dealers, which are mostly banks licensed by RBI; and C, the exporters, importers, companies and other foreign exchange earners. Foreign exchange brokers are also there who act as intermediaries. Following types of dealings take place in this market: A, transaction between authorized dealers and RBI; B, transaction amongst authorized dealers and themselves; C, transactions between authorized dealers, brokers and exporters, importers, companies and other foreign exchange earners; and D, transactions with overseas banks. The currencies are traded on spot or cash basis for immediate delivery and on forward basis for delivery at some times in future at price fixed today. Let us now understand the concept of efficiency as applicable to foreign exchange market. Concept of efficiency of financial markets refers to a situation where all information is available to all the market participants and market prices fully reflect them. Bid-ask spread concept is applicable in case of gauging the efficiency of foreign exchange market. This concept reflects the transaction and operating costs involved in the transaction of the currency. The risk involved in holding the foreign exchange currency is also a part of this cost in the spot trading. With the increase in the volume of foreign exchange transactions, the bid-ask spread cost declines. The lower and stable the cost, the more efficient is the market, reflecting high liquidity and complete dissemination of information to all the market players. Indian foreign exchange market has low spread and trading volumes has negligible impact on the exchange rate spread, thus depicting a less volatile market and reflecting efficiency gain. We shall now recapitulate what we have learned so far. Number 1, financial market refers to a marketplace where sellers and buyers participate in the trade of assets such as equities, bonds, currencies and derivatives. 2. The main function of financial market is allocation of resources from the surplus spending units to the deficit spending units. 3. A well-developed financial market is an absolute must for the growth of the economy and for the integration of the domestic market and international market. 4. Financial markets are of following types: money market, capital market, government and securities market, corporate debt market and foreign exchange market. 5. Efficiency in the financial market refers to a concept where there is no wastefulness in the use of resources and information is available to all the players in the market. 6. There are 5 criterion to judge efficiency. These are: information arbitrage efficiency, fundamental valuation efficiency, full insurance efficiency, operational efficiency and allocational efficiency. 7. Various types of financial markets are evaluated on the basis of above concepts of efficiency.